What home buyers should know about mortgage interest rates. When buying a home, one of the most important things you'll hear about is mortgage interest rates. Even a small change in interest rates can affect your monthly payment, your buying power, and the total amount you'll pay over time. For many buyers, especially first-time homeowners, mortgage rates can feel confusing. But once you understand the basics, it becomes much easier to make smart financial decisions. So let's break it down in a simple way. First, what is a mortgage interest rate? A mortgage interest rate is the cost of borrowing money from a lender to buy a home. For example, if you borrow money to purchase a house, the lender charges interest in exchange for providing that loan. That interest is added to your monthly mortgage payment. And here's why rates matter so much. Even a small increase in interest rates can make a big difference in your monthly payment. A lower interest rate usually means lower monthly payments, lower total loan costs, and greater buying power. A higher interest rate means higher monthly payments, less affordability, and more money paid over the life of the loan. That's why buyers pay close attention to rate changes. Now let's talk about how mortgage payments work. Your monthly mortgage payment usually includes the principal, which is the amount you borrowed, the interest, which is the lender's charge, property taxes, and homeowner's insurance. In the early years of a mortgage, a larger part of your payment goes toward interest instead of reducing the loan balance. Over time, more of the payment goes toward the principal. There are also two main types of mortgages buyers should know. First is the fixed rate mortgage. With this option, your interest rate stays the same for the entire loan term. Your monthly payment remains predictable, which makes budgeting easier. This is usually best for buyers planning to stay in the home long term. Second is the adjustable rate mortgage, also called an ARM. This type often starts with a lower rate, but the rate can change later depending on market conditions. That means payments may increase in the future, so there's more financial risk involved. Several things can affect the interest rate you receive. Your credit score is one of the biggest factors. Higher credit scores usually qualify for lower rates. Your down payment also matters. Larger down payments can reduce lender risk and may help you secure better loan terms. Economic conditions also play a role. Inflation, Federal Reserve policies, and overall market conditions can cause mortgage rates to rise or fall. Another important tip is this: always shop around. Different lenders may offer different rates, fees, and loan programs. Comparing multiple lenders can potentially save you thousands of dollars over time. You should also understand the difference between interest rate and APR. The interest rate is simply the borrowing cost. APR, or annual percentage rate, includes the interest rate plus additional loan fees and costs. APR gives a more complete picture of the total loan expense. Many buyers also ask, should I wait for lower rates before buying? The truth is, nobody can perfectly predict the market. Sometimes rates drop, but home prices rise. And in many cases, homeowners can refinance later if rates improve. The most important thing is choosing a mortgage payment that feels comfortable for your budget and lifestyle. At the end of the day, mortgage interest rates affect much more than just monthly payments. They influence affordability, financial flexibility, and long-term home ownership costs.